All right, let's dive straight into today's explainer, where we're going to put a 50-year-old coffee roaster through the ultimate investing gauntlet. We want to figure out, is this a hidden gem, or is it just a dangerous value trap? We're looking at Coffee Holding Company, ticker symbol JVA. They've been in the game since 1971, and today we're dissecting their financials and business model using the strict frameworks of some absolute legends in the investing world.
Here's our roadmap for today. First, we'll meet Coffee Holding Co. Then, we run them through the legendary investor gauntlet. After that, we'll unpack the red flags, followed by the green flags. And finally, we'll wrap it up with our final verdict. Let's get started.
Let's kick things off with Section 1, Meet Coffee Holding Co.
So, to really grasp what we're dealing with here, we have to look at the scale of this operation. Right off the bat, you need to know JVA is a true microcap stock. We're talking a market capitalization of just under $19.5 million. Now that's crucial because microcaps come with this dynamic of super high risk, but potentially massive reward. To put that tiny size into perspective, they run this whole thing with an incredibly lean team of just 92 employees. So, we aren't talking about a massive multinational conglomerate here. This is a small, tightly run ship. But here's the thing. Despite that tiny size and small headcount, they actually use a highly scalable merchant roaster model. They are totally vertically integrated. That means they handle literally everything, from sourcing over 90 different specialty green coffee varieties, all the way through the roasting, blending, packaging, and finally, distribution. They're serving a huge spectrum of clients too, from your favorite little local roaster all the way up to massive corporate buyers. Honestly, it's a pretty impressive footprint for a company worth barely $20 million.
Moving right along to Section 2, the legendary investor gauntlet.
Now it's time for the ultimate stress test. We know what they do, but just how robust is this business really? Let's see how JVA holds up against the legendary frameworks of Benjamin Graham, Peter Lynch, and Warren Buffett. And, well, right out of the gate, JVA seriously struggles with one of the most critical concepts in investing, a competitive advantage, a moat, that invisible wall that protects a business from its rivals. According to the Guru Focus Moat score, JVA gets a pretty dismal 3 out of 10. They literally classify this as no moat, very weak or transient. Why? Because the packaged food industry has incredibly low barriers to entry. I mean, almost anyone can start roasting coffee, right? And JVA just lacks the strong consumer brand loyalty, or cost advantages, or proprietary tech needed to keep their competitors at bay.
So when we bring out the Warren Buffett checklist, it's pretty rough. JVA fails almost every single metric. Buffett famously demands a return on equity of at least 15%. JVA, they're sitting at a meager 5.32%. Buffett wants a gross margin of 40% or higher. JVA is barely scraping by at about 16.5%. Now sure, they pass his test for having a simple, easy-to-understand business with relatively low debt. But without that durable moat or strong profitability, yeah, Buffett wouldn't touch this with a 10-foot pole.
Okay, but what about the father of value investing, Benjamin Graham? Well, at first glance, JVA actually looks like a dream scenario. It trades around $3.39, which is a massive 39% discount to its estimated Graham number of $5.56, which, if you remember, is Graham's formula for a stock's maximum fair value. It's even trading below net book value with a price-to-book ratio of 0.67. But, wait for it, here is the absolute deal breaker. Graham strictly demands 5 to 10 years of stable, consistent earnings, and as you're going to see in a second, JVA's earnings history is wildly unstable. That completely disqualifies it from being a classic, safe Benjamin Graham deep value play.
And for Peter Lynch, the legendary growth investor, sadly, it's a very similar story. Lynch relies heavily on the PEG ratio, right? He wants the company's price-to-earnings multiple to be lower than its growth rate, just to make sure he isn't overpaying. But because JVA's earnings are so incredibly erratic, literally swinging from heavy losses to sudden profits and back again, including a massive recent quarterly earnings per share drop of 59.2% year over year, their growth rate is basically impossible to calculate reliably. And for Lynch, that means he'd avoid this stock outright. It's just way too unpredictable. Which brings us to Section 3, Red Flags, the hidden risks. So it's looking like a bit of a bloodbath for JVA when measured against the greats. Let's dig deeper into these under-discussed risks that mainstream media might just be totally missing when they look at top-line sales. The media might praise their 2025 sales growth, but their earnings rollercoaster really proves JVA is fundamentally a cyclical commodity processor, not some compounding growth machine. We're talking consecutive quarters of losses across 2022 and 2023. Then, a brief shiny flash of recovery in 2024, hitting 39 cents per share,
only to slump back down in 2025 to 25 cents. I mean, this is the textbook definition of earnings volatility.
And it doesn't stop there. There are severe underlying risks here that any retail investor needs to be acutely aware of. First up, massive customer concentration risk. For a company doing around $100 million in revenue, losing just one major client, that could be financially devastating. Second, we're seeing internal governance weaknesses and real risks surrounding the refinancing of their revolving credit facility. And finally, the classic microcap liquidity trap. The average daily volume is a measly 60,000 shares, and the stock is down 46.5% over the last 12 months. In a real market downturn, that liquidity could vanish in an instant, leaving you completely trapped in the stock. Here is a perfect real-world example of just how fragile their position can be. In late 2025, to protect their clients from a sudden wave of tariffs, JVA actually decided to absorb those costs themselves. The result? A negative cash balance of roughly $1 million for that period. Now, on one hand, it's super admirable that they prioritize their customer relationships, but on the other hand, it's just financially unsustainable for a company of this tiny size to act as a financial shock absorber for global trade issues.
Okay, let's shift gears. Section 4, green flags, the hidden value.
So, it fails the gurus, the earnings are a mess, and the risks are undoubtedly high. But before we write this stock off completely and toss it in the too hard pile, let's pivot. Let's look at the hidden catalyst that might actually make this a compelling, albeit very risky, buy. Despite all the turbulence we just talked about, JVA is incredibly cheap. We're talking a price-to-earnings ratio of just 12.65. Compare that to the broader packaged food industry average of roughly 25.7, and you're looking at a roughly 51% discount compared to its peers. The market has severely punished this stock, which might just have created a massive margin of safety.
And that discount gets a whole lot more interesting when you look ahead to the future. Management is actually expecting some massive margin expansion in 2026. Remember those tariff headwinds that cost them $1 million? Those are expected to be totally eliminated. On top of that, they're projecting anywhere from $750,000 to a full $1 million in annual savings purely from plant consolidation. Plus, all those one-time integration and shutdown costs that plagued 2025, gone. If these catalysts actually hit, we could see a really substantial upward re-rating of their margins and, by extension, their stock price.
Additionally, for such a tiny microcap company, management's interests are surprisingly aligned with shareholders. They boast a really high insider ownership of nearly 13%, right alongside about 12% institutional ownership. And you know how the saying goes, when the people actually running the company own a significant chunk of it themselves, they are highly incentivized to turn the ship around and unlock all that hidden value.
And honestly, this optimistic outlook is backed up by the pros. Zacks Investment Research actually initiated coverage back in March 2026 with an outperform rating. They specifically pointed out JVA's really unique positioning in the specialty green coffee market and the underlying scalability of that vertically integrated merchant roaster model we were looking at earlier.
Let's bring it all together. Section 5, the final verdict.
So we are left with a truly fascinating dichotomy. We've seen the brutal failures against the legendary investing frameworks, we've unpacked the terrifying liquidity and concentration risks, but we've also seen the deep value catalysts and strong insider alignment. Let's synthesize this. Is JVA a Peter Lynch growth stock? Absolutely not. Is it a Warren Buffett quality compounder? No way. It totally lacks the moat and the margins. Does it fit Benjamin Graham's deep value? Well, only partially, because while it is dirt cheap, it completely lacks the earning stability Graham demands. But when we view it as a special situation, JVA perfectly fits the profile of a turnaround play. It's a microcap with very real catalysts lined up for 2026, trading at deeply compressed multiples.
Ultimately, analyzing coffee holding company comes down to a very specific weighing mechanism. On one hand, you have the very real bearish dangers: no durable moat, wildly unstable earnings, massive customer concentration, and the frankly terrifying prospect of a microcap liquidity trap where you literally can't sell your shares during a panic. But on the other hand, the bullish thesis is undeniable: a nearly debt-free balance sheet and strong short-term solvency, all priced at a massive discount to its true book value.
So I'll leave you with this final thought to ponder. Investing is rarely black and white. For the Buffett and Lynch purists out there, this is an incredibly easy pass. But for the risk-tolerant value hunters who can stomach the terrifying roller coaster of a $20 million microcap, does this deeply compressed valuation offer enough of a safety net to bet on a massive 2026 turnaround? What do you think?